The daily bias is exactly what it sounds like. It's a way to determine if the next day will be bullish or bearish. We can determine that in a very simple way using the previous day's high and low and the observation of what price does at these extremes. Let's look at the basic idea of the bullish daily bias. Let's say you begin with this candle and you mark out the high and low of the day. In the next candle, price breaks and closes above the previous day's high. That would generate a bullish bias for the next day. Another example of bullish bias is when price fails to move below the previous day's low, like so. Notice that price breaks the low, but it cannot close lower. In the second case, we can expect the next day to be bullish, or at least the high to be met. In the case of a bearish daily bias, the rationale is the same. If price breaks and closes below the previous day's low, we have a bearish bias for the next day. If price breaks and fails to close above the previous day's high, we also have a bearish bias for the next day. In the second case, we can expect the next day to be bearish, or at least to reach the previous day's low. This concept, like many others, is better understood in practice. So let's take the daily chart of the dollar index to see how this works. Let's say we begin with this current candle. The first step is to mark out the high and low. Moving on to the next candle, we can see that it broke and closed below the previous day's low. So we have a bearish bias for the next day. We mark out the current high and low. Two things can happen in the next candle. We should see price reaching this low, which in this case is very close to the current price, or we should see price break this low and close below it. In the next day, we can see that our bearish bias was correct, and since price closed below the previous day's low, we continue with the bearish bias for the next day. Now we mark out the new high and low. We should see price breaking to the downside, or at least reaching the new low. In the next candle, we can see that our bias was correct. Since price closed below the previous day's low, we continue with a bearish bias. We now mark the new high and low. Price is expected to at least reach the new low, or break and close below it. In the next candle, we can see that price moves sharply to the downside, once again confirming the daily bearish bias that was anticipated in the previous day. We now mark the new high and low. Once again, we expect price to reach the new low or break and close below it. In the next candle, we can see that the bearish bias was correct, and we mark out the new high and low. In the next candle, we can see something new happening. Notice that we did reach the previous day's low as expected. We broke the previous day's low, but we closed back up into the range. This generates a bullish bias for the next day. We now mark the new high and low. In other words, we should see a bullish candle surpassing the previous day's high, or at least price reaching the previous day's high. In the next candle, we see price reaching the previous day's high as expected, but a bearish candle appears, so our bias was wrong in a way. But it was correct about reaching the previous day's high. Notice also that we broke the previous day's high and failed to close above it. This generates a bearish bias for the next day. We must also update the high and low to the current candle. Since the bias now is bearish, we expect price to at least reach this low or break and close below it. In the next candle, we can see that price does reach the previous day's low but failed to close below it, generating a bullish bias for the next day. Before moving on, we must update the high and low to the current day. Now we have a bullish bias for the next day, so we should see price at least reaching the previous day's high or producing a bullish candle that surpasses that high. In the next candle, we see that price did reach the previous day's high and surpassed it, creating a bullish daily bias for the next day. Before moving on, we update the new high and low. Once again, we should see price at least reach the previous day's high or surpass the previous day's high in a bullish daily bias. In the next candle, we not only reached the previous day's high, but we also surpassed it, creating a new bullish bias. Now we update the new high and low. We expect price to at least reach the previous day's high or surpass it and close above it. In the next day, we close above the previous day's high, creating a bullish daily bias for the next day. And now we update the new high and low, expecting price to at least reach the previous day's high. The next day, we see price closed above the previous day's high, generating a new bullish daily bias for the next day. Updating the new high and low, we expect price to at least reach the new high in the next day. In the next candle, we did reach the previous day's high, but price failed to close above it. That generates a bearish bias for the next day. Updating the new high and low, we expect price to at least reach the previous day's low now. The next day, price not only reached the previous day's low, but it also closed below it, generating a new bearish bias for the next day. Updating the new high and low, we now expect price to at least reach the previous day's low. The next day, we see that price indeed reached the previous day's low and then created a bullish candle that closed above the previous day's high. By the way, notice how price reversed at a fair value gap in here. Now we have a bullish bias for the next day. Updating the new high and low, we expect price to at least reach this high the next day. Moving one candle to the future, we see that price did reach the previous day's high, but failed to close above it, therefore generating a bearish bias for the next day. Updating the high and low, we now expect price to at least reach the previous day's low. The next day we have an inside bar, so we failed to reach the previous day's low, and we don't have a bias for the next day. Now we can update the new high and low and see what happens. The next day we close above the previous day's high, generating a bullish bias for the next day. Updating the new high and low, we expect price to at least reach the new high in the next day. Moving forward, we can see that we did reach the previous day's high and close above it. I guess you can get the idea of how this works by now. In all these candles, the bias only failed to meet its condition once when the inside bar appeared. In other words, it worked most of the time. This idea of the daily bias can also be used in intraday charts. The principle is exactly the same. The daily bias can be used to frame a trade in a lower time frame as well. This finishes this beginner's guide to the ICT method. The ICT method goes much further than this, but these are the foundational concepts you can incorporate in your trading right away. If you want to go deeper into it, you can visit ICT's channel in the video description. That's it for this video. If you enjoyed it, please help support the ongoing creation of free videos like this one by clicking the like button, subscribing to the channel, activating the notifications, leaving your feedback in the comment section, and sharing this video with your trading community.